Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and in the series of year-end special editions which we are consistently getting you from this entire week, you are getting to hear from the top stock market investment voices as to what is it that should be on your top radar when you plan your investments for the upcoming new year. Now, this is just the right time when you reflect back on the year gone by in 2024, the things that you did right, the things that you fell short of, and also devise a strategy that would work best for your long-term goals in 2025 as well. Remember, mutual funds, which is at the heart of your personal finance and investment journey, we've actually seen that the industry, after a stellar 2023, also sustained its growth momentum in 2024. An impressive 17 lakh crore surge in assets is what we've seen. That's driven by buoyant stock markets, robust economic growth, and increasing investors' participation as well. In fact, the year 2024 saw a substantial net inflow of over 9 lakh crore rupees and a significant 5.6 crores increase in investors' count as well, and a growing popularity of SIPs, which alone contributed 2.4 lakh crore rupees in the industry. Remember, the monthly SIP contributions also consistently surpassed the 25,000 crore rupee mark in October and November, signaling their growing appeal as well. The inflows lifted the industry's assets under management, reaching an all-time high of over 68 lakh crores by November end, marking a 33% growth over 50.7 lakh crore rupees that was registered at the end of 2023. And this is the right time that we should be discussing how should you go about investing in your personal finance journey in the new year 2025, which are the kind of mutual funds that you can actually look at, what are the tweaks that you need to do in your own portfolios as well. Two very special guests who are marquee investors, legendary names in the Indian investment journey that you have been hearing on our channel often as well. We have with us on our show Mr. Feroze Azeez. He is the Deputy CEO, Anand, Rathi, Wealt. And we also have with us Dhirendra, Kumar, the CEO of Value Research, joining right in. Warm welcome to both of you, and thank you so much for taking the time out for this discussion. Let me start off by understanding from you, Dhirendra. Let's take that step back and reflect on the year that's gone by, and give us some understanding on the key learnings that as an investor you also picked up that for the year 2025 should be on top of the mind for investors as they get into the new year.
No, one thing is that, something which comes on the forefront is that predictions don't work. There were almost doomsday being predicted at the beginning of the year. Then we had this, the impending election.
Yes.
And everybody was expecting a result, and we got a surprise, or, so-called surprise. Market was shaken, but, eventually it turned out to be far more resilient. If you look at all the key surprises that we got, globally the government started, raising the interest rates. The legitimization of Bitcoin with the launch of an ETF by SEC or putting, despite these milestones, and that definitely is visible. Bitcoin crossing $100,000 mark. But looking at the Indian market and what Indian investors have experienced, apprehension about small cap and this and that, I think there is a lesson to be taken that chart your course and just stick around and don't bother about what we are saying.
Okay, got that. So predictions can often go wrong is one thing that you should definitely keep on your top radar.
It could be a distraction,
And it could be a distraction. Yes. Okay. Feroze, to you, then tell us, what were the key highlights, takeaways for you from the investment journey that investors went through in 2024? Where did we go right and where did we go wrong?
See, I think investor journey, I'm very pleased with the disciplined approach which India has displayed in the year 2024. If you look at the beginning of the year, the SIP amounts, after almost 30 years of the mutual fund industry being privatized, had reached 17,000, 18,000 crores a month. And in just 1 year, we've moved from 18,000 crores to 25,000 crores, which is almost a 50% jump, which is a 15 years का काम एक साल में हुआ है. That's a great thing. That's a great barometer to see whether India is respecting equity, point one, respecting discipline, point two. We were great savers. I think there's an indication that we're moving towards great investing principle as well. The second, on the same note, I think this is the third or fourth year where I'm seeing HNIs going wrong with their market timing horribly. in starting from FY 21, where post-COVID, when it was a screaming buy, when Nifty averaged at close to 10,900 on all working days, equity mutual funds, HNI money, left equity mutual funds by to the extent of 20% of the AUM then, which was 6-7 lakh crores. HNIs removed 1.5 lakh crores. So point one I'm making is retail has gone significantly right again, and HNI has got significantly wrong, and the distractions largely have been tremors for not the retail space, like Dhirendra said, has distracted the HNI more. Lesser the advice, the more the profitable that segment has been. Being a distributor, I'm acknowledging that because I am in the HNI space. So that's one learning. Learn from the retail was the mantra for FY for the calendar year 24. And now looking at the other thing, which is one of the surveys which I did, which because something which was perturbing me was not from a mutual fund industry standpoint, but people actually dabbling in derivatives. And to
Yes.
my mind, being on the derivative screen for the last 18 years, people who don't do who do derivatives as a part-time job, they don't know option Greeks, delta, vega, gamma, theta, rho. And the second order Greeks also they don't know, but they still dabble and try to bet against somebody who has done that for a living. So I did a survey in three different events, which were retail events. There were only two questions asked. Do you do derivatives? And if 100 people said out of the 200 in the room said they do derivatives, the second question to those 100 people, do you also
Would
do
you make
SIP?
me an? Okay.
72% of them said that they also do SIPs. So this is not a mutually exclusive set like it might be made to believe.
Correct. Absolutely. So those are the key takeaways then. Now, Dhirendra, I'll come to you with a forward-looking question now. We have seen a lot of resilience being played out in the equity markets in the first 6-7 months of 2024. No matter that we saw a lot of headwinds, but we came out stronger every time. But in the last 3 months, from October onwards, that resilience is somehow testing investors' patience. Why are the markets not able to come back now? Is the big question. And this is also for the first time. You did point out, and so did Feroze, all of these investors who've been going strong and big by investing in their money in mutual funds via SIPs are now wondering as well that, will the markets have the strength to continue to give them that kind of a return that we have seen in the last 3-4 years. So what is the outlook A on equity markets that you believe? Even if there is a tempered expectation that you believe investors should have, what is the right strategy to continue to invest in equities?
Investors should continue with the same strategy as they have been at it. Last 2, 3 years, 4 years, any investor who has come has stick around with his SIP. And I don't think any domestic investor has been shaken at all. In fact, only the month of October we saw some withdrawal by domestic investors, and I think that is quite natural. In the month of Diwali, people take out a part of their money to
Yeah.
spend, and I think that's the wise thing to do. If you're feeling happy about your investments, and I don't think people are getting upset with their SIPs and whatever returns they are getting, or they are getting fearful of the height. I think most of the disturbance, or most of the volatility has come from the actions of the international investors investing in India. The foreign portfolio investors, they have their own dynamics, they have their own dimensions, and they have their own triggers. And when they pull out, they are big investors in the domestic market, and when they pull out, there is a degree of a kind of herd mentality, and that drags the market. Despite that, our market has shown the kind of resilience which we have never. It is unprecedented. I think another thing which was there is a segment of the domestic market which is buying the trendy fund, the NFO boom, and that is something which I'm wary of. That is where I feel that there are some investors trying to bet on something, or buying into such stories, and it is fine to be dabbling into that. But the point is that 80% of your investment should be with a long-term orientation, should be diversified. That is a free lunch going on, and just have it. Uh, and that is something, and look at it as a sacred money which you will not touch based on just because the some money is there is a drag in the market, or market has gone down very sharply, because markets will be like this only. They will
Correct.
always go. really up and they will come down very dramatically in a brief period of time. We saw it last week. And I think that is going to be repeated time and again. It will be a test of your patience. But most investors who have come in the last 3, 4 years, they are sitting on such huge profits. Investors have a very different attitude towards their returns. You lose your gains, all of it, you don't mind, but you lose a small part of your principal. So if any investor has been around, his attitude to risk is very different today.
Absolutely. Let me get Feroze also on the same. What mutual fund strategies do you believe should be recommended and investors should focus on then, keeping in mind all of these facts that even Dhirendra has alluded to, that the markets could be continuing to be volatile. We have a lot of moving parts here. US, there is going to be the new president taking office. Policies will be changed. There are a lot of stimulus that's taking place in China. So a lot of things will be moving forth here and forth. Of course, inflation, we have our own problems as well domestically. So looking at that, are there going to be changed strategies for 2025 or should one stay the course?
Shakshi, firstly, I don't subscribe to the narrative that Indian markets have been volatile. Okay, numerically on an Excel sheet. Okay, in perception, though, we can, in English, we can describe Indian markets to be volatile, but in mathematics, no. On 22nd March 2020, okay, little over 4 years back, there was a circular which came in India a day before your lockdown, that there is going to be a limitation on the amount of shorting a person can do, which is
Okay.
selling a commodity before owning it. Is called shorting. Like if you want to sell a house, before you sell the house, you have to buy it, right? But in equity markets, it is possible for you to sell a share before buying it. That's called short selling. That was limited on 22nd March 2020 for a 500 crore notional amount, which is almost a piddly amount if you do in the options market. That circular is still live. It's been a long period. After that day, our market represented as Nifty is lower volatility than S&P 500. Nifty has 50 stocks, S&P 500 has 500 stocks.
Right.
And S&P 500 represents 50% of the world's market cap. That's volatility is more, 18.59. Nifty's volatility from that date till 30th November, which is the latest data I have, is 18. So Indian markets have been resilient. I'm just giving numbers to what Dhirendra said. They have this circular has a very large role to play. 1st April 2025, SEBI has tightened this circular further instead of withdrawing it. And I think that's the biggest gift which SEBI has given to investors, making it a non-speculative, more investor-friendly and lesser trader-friendly
Okay.
market. So much so that options market in India defy the only Nobel Prize winning formula week after week, which is called the Black-Scholes pricing model. So they're not volatile. Secondly, coming to your pointed question, sorry to digress, but I think this is very little spoken about, even in
Yeah.
mainstream media on market shows. But I think it required attention of your viewers, at least in the
Sure.
year 2025. Now coming to the mutual fund strategies, I would say look at the market cap driven classification. A
Okay.
focused fund, mid cap fund, small cap, large and mid cap, and a multi cap could be a good mix of categories which you can focus out of the several which are there
Okay.
for
We'll
one.
Sure. We'll come down to that and maybe focus a little bit on all of those that you have pointed out. But let me get Dhirendra also on this. Dhirendra, you pointed out to a very important fact. This rush of NFOs that we have seen that usually distract a lot of investors. We've often also seen that some of these NFOs are actually launched towards the peak of a theme or a sector really rallying. Case in point, when we talk about the defense NFOs that they started to come in, we had already seen a large part of returns come in onto these defense stocks, and after that it's been plateauing or consolidating a bit. What is it that you would want to advise when investors look at these sectoral thematic funds in 2025? Do you think some of them will do better? Is it better to continue to stay focused with what Feroze said, a multi-allocation fund? Maybe large, mid and focused funds is something that we should look at. What is your own suggestion?
My suggestion is that investors will not be deprived of anything if they completely ignore the sectoral and thematic, funds.
Okay.
Uh, you know, Investors should understand that this is, mutual fund is a consumer product. and consumer product often are sold based on a story. This is the magic it will do to you, whether you buy a cosmetic or and on that front, and I think it is fine for investors to be investing in them. Naive beginners, they will do it, and it is fine in the sense that investors have, my understanding over the last 20-30 years
Yeah.
is that people don't learn from history. They have to lose their own money, and they should lose it as early as possible, get that experience, and either get out of the market forever or experience it and understand that how it works. Because if you are not willing to understand how it works, it's your money, you better worry about it. This is not the first time. It happened in 90s. It happened in the technology boom. It happened in the infrastructure boom, in 2007. It has happened recently in four or five such things. There are such narrow segments of the market in which and investors are getting a different excuse. Now SEBI has a clampdown on the number of categories or number of funds you can have in a specific category. Now every fund company has found a excuse. They are asking the index producers to create a specific index for them, and they are launching one. Now I find it uh, I find it very humorous. But there's a conflict of interest. Here is a company which or here is a business which makes money only by raising money, but you as an investor make money only if it grows from here. And when you are tempted to buy a story, it is generally at its peak. The odds are against you. I think there is nothing like there are segments of the market which we are deprived of. I would like every investor to be investing in the international market, but they can't. And I would not suggest them to invest in any other manner beyond mutual fund, because that is the safest, well regulated, and the simplest way in which you can invest. And that is the window which is coming to an end. I'm very scared and I'm very fearful of what is going on in the market. Most international ETFs which are listed and traded in the market are trading at premium of anywhere between 10 to 30%. Now, anybody who buys it is he's very likely to lose, and he's guaranteed to lose if tomorrow is Reserve Bank permits investing abroad again by because right now there is a ceiling of $7 billion per for the whole industry, $1 billion per company, and $1 billion for ETFs, of which one company there is a ceiling of $300 million. If and that has been that ceiling has been hit, and funds are not permitted to invest there. If that is opened up, every investor who is investing in the market based on the momentum that they are witnessing right now will be losing money. Be wary of it. I agree with Feroze that right now it is time to be investing in multi-cap funds, and multi-cap as compared to flexi cap are becoming more attractive because they are forced, because most multi-caps they became almost large cap funds, simply because all these fund managers, they tell you that they're multi-cap, but as they have raised, they have got so much more money that most multi-caps have become 90% large cap funds. And 90% large cap fund doesn't make a flexi cap fund investing 90% of its money in large cap doesn't make sense, because you get the Nifty at 10 basis point, and the likelihood of a fund manager or the number of fund manager who will beating the large cap index, that number is shrinking. There are few of them who are doing it. They can justify their fee. So I would say that look for a multi-cap fund, keep it narrow for your long-term money. Make sure that you are not investing your short-term money in equity, and if you are able to completely give a pass to all the sectoral and thematic fund which will be clamoring for your attention and money, ignore them.
Okay, interesting point right there. Feroze, I'll bring you in on that front too. One, on if you could continue to give your views on the geographical diversification as well, something that Dhirendra alluded to. And apart from that, the top schemes that you believe within these categories that you've named that you can share with us.
So actually, I'll just like to put some numbers to Dhiren sir's worry on the NFO. If you look at FY, even if you look at this financial year, which is only 9 months till December, we have already launched 143 NFOs. Last year, full financial year, I'm speaking financial year 107. Previous year it was 80. In FY17, there were only 7. Like Dhiren sir said, everybody had a bouquet permitted by SEBI कि इतनी स्कीमें आप रख सकते हैं. Once the bouquet got over, you're still wanting to raise money, so you're forcing yourself to come up with themes and create indices, and then you're taking smart beta or whatever conventional, unconventional, open canvas. Basically, someday you can always have a theme saying, I'll only buy companies with which start with alphabet A, right? That is also a theme for that matter. Then there's no limit. Sky is the limit in terms of this. So NFOs were scary. But one number which gave me some calmness is I looked at the top three AMCs and said that if I, as an investor, bought every NFO ever launched by this AMC, would I beat Nifty? You'd be surprised if I look at HDFC as case in point. If I bought every NFO they launched, I put, let's assume, 5,000 rupees in all of them, I would have beaten Nifty by 6.39% per annum. Okay, which gave me some santvana that some of the large AMCs are timing them not at the peak, but some of them are timing at the trough. Like you spoke of defense, HDFC. So that's one. Now coming to the schemes, which are very important for me to read out for the viewer. ICICI Focused Equity, Kotak Emerging Equity, Invesco India Small Cap, DSP Equity Opportunities, and SBI Contra or Kotak Multicap. One of these two. So 5 schemes from 6 different categories you can choose.
Okay, there you have it. Those 5 names will be up for you, all of you to see, and you can definitely look at investing in them in the year 2025. Dhirendra sir, how would you really recommend on this front? How should one go about investing in particular schemes?
I would say that, choose the dull and boring way of investing in mutual fund, which is, go for the timeless fund. And today, my timeless selection will only include, multi-cap fund. And, if you have 1 or 2 or 3, that is good enough. And
Okay.
if at all, or you can create a portfolio of, just 1 or 2 index fund and supplement it with small cap fund or mid cap fund, 1 or 2 of them, and that will be good enough. 4 funds for an investor, which is 2 index and 1 small cap and mid cap. I think, and look for all those, create a checklist of things that a fund must have before you invest, and that's about it. 4 of them will do the, expect, the only way you can be happy with a mutual fund is, have a reasonable expectation from here on.
Okay, reasonable expectation is something that you should have. But what about equity versus debt, Dhirendra sir? How are you really looking at that aspect play out in 2025?
No, I think, equity versus debt is not something for an investor to do. Your short-term money should always be in fixed income, whether it be lying in your bank or something. And if you're trying to benefit from a rate cut, I think most fund managers over the last 10 years, on 3, 4 such key occasions, when they got excited about it, they lost money and they lost investors' money. So I would say don't try and guess what RBI will do, what the government will do, what other investors will do. Focus on what you need and don't
Okay,
bother.
interesting. Interesting point. Feroze, what about you? Equity, debt, passive funds, how are you really going to be playing out all of that?
I would say that debt, I would not play long-term debt saying interest rates will be reduced and you will make money. That's a wrong narrative. Because when the repo rate went up from 4% to 6.5%, the 10-year GSEC has not moved up. In fact, it has moved down. Okay, so when you didn't lose money when the repo went up, why are people expecting to gain money when the repo comes down? Okay, if you look at 9 months back, the repo rate was 7.3. Now it is 6.88. Well, the repo rate was 6.5. Repo has been 6.5. But 10-year GSEC has come down. So you making money out of the long-term debt is a wrong narrative because bond portfolios have not had a mark-to-market loss, even in the steepest rise of repo we have seen post-COVID. So that's completely subscribed to Dhirendra's view. Coming to the equity side, I personally, again, subscribe to what he said. If you have 5-year plus monies, if you don't have 80% in equity, you are wasting time. Because you're not in a high inflationary economy like ours, where there is compulsory investments in debt, people are overexposed to debt. If Indian household savings only have 6.7% in equity from a financial services pool and 90% is in debt. So I think buying debt or me propagating debt would be a wrong philosophy because Indians are overexposed to gold, debt, real estate. Equity is something which they have stayed away for generations. Because of the wrong expectations, like rightly highlighted by Sir.
Right. Feroze, lastly, I also wanted to bring in something that Dhirendra was also alluding to earlier. He talked about Bitcoin and crypto. I wanted to also ask you on the bullion aspect, gold, silver. It's definitely outperformed. How is that likely to play out? Should there be a clear, allocation to gold and silver in 2025? And should one also look at an exposure to crypto, looking at how the mother market US is favoring newer policies within this aspect?
Yes, I think, I would say gold, people only buy, they never sell.
Yeah.
Real estate, they sell in 10, 12 years. That's the average. I've done a survey of HNIs who own 2 lakh crores.
Okay.
So real estate, they sell in 15 years. Gold, they never sell. They say, itne bure din nahi aaye ki main apne ghar ka sona bechunga. So whenever it comes to bullion price, they only look at price from a purchase standpoint. When they look at equity price, they only look at price when it is selling time. Okay, so point I'm trying to get to is, if an investor in 2025 can pledge that, bhai, whenever I will look at equity, I promise to review real estate and gold too. The frequency of review for all assets have to be equal. Then all assets, you are giving them a fair chance to work for you. Equity आपको 1 महीने में review करना है, gold 20 साल में करना है, एक real estate 10 साल में review करना है. Keep the frequency of review identical. Now coming to your pointed question of gold, I would say gold is going to be an asset which is a great debt replacement, and it will remain so. It can never replace equity because it has delivered only 9.3% return over the long term, that too in rupee terms, in spite of the rupee depreciation supporting the gold values.
Okay, got that. We will thank you then, Feroze and Dhirendra, for those wonderful insights that you've shared with all our viewers. Time is short, but this discussion could have just gone on and on. It's an interesting one, but we promise to get both of you back into the new year so that you can guide our viewers further on from what we've shared at this in this special show as well. Season's greetings yet again to both you and Dhirendra for sharing such wonderful insights. May this new year come up to be a very strong personal, professional front on all walks of life. It turns out to be the best one for you thus far. Thank you so much. All right, viewers, we'll wrap it up at that. Do stay tuned on to Business Today as we will continue to get you such fascinating insights and conversations from the top-notch investors in India to help you, guide you through the new year and the strategies that you should be adopting. Stay tuned. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is yet another year-end special interaction that we're going to be having with a top market master for all of our viewers on this new year and year-end specials. Remember, the Indian equity markets so far in 2024 have had shown a lot of resilience for a major part. We've faced so much, navigated through a lot of challenges, be it higher inflation, weaker than expected earnings, general election outcomes, the FIR outflow.